lessons from the most successful investor in the world, some Warren Buffett quotes, and what's the best structure for owning an investment property.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Thanks for joining me this week for episode 9 of the Michael Yardney podcast. It only seemed a few weeks ago we started producing these podcasts. Thank you so much for ranking us so highly on iTunes and for all the great reviews we've had. I've been having a lot of fun putting these programs together and I hope you're getting some lessons out of them. This week, I'm going to give you some lessons from the most successful investor in the world. In my mindset moment, I'm going to share some quotes from Warren Buffett, and my special guest today is Ken Race, Director of Metropole Wealth Advisory, who's going to answer a question about what are the best structures for owning an investment property. Lots of great information today, so let's get started. You've often heard me say you should have a mentor. Some of them, there'll be people you've met, some are people you're going to pay, some are people you're going to admire from afar and learn about. And Warren Buffett, who's arguably the greatest investor of all times, has been a mentor to many investors. He's got a fantastic record of creating but also maintaining his wealth. Now, while he's mainly a share investor, many of the principles that he uses also apply to property investors. So today I'd like to have a look at some of Warren Buffett's investment principles, and let's see how we can apply them to our property investing. The first principle is to adhere to a proven strategy. Buffett's success has been put down to his extraordinary patience, his discipline. He never deviates from his proven investment strategy, even faced with short-term challenges in the market. Now, this is a great lesson for property investors, as most don't have a plan, most don't adhere to a proven strategy. In fact, they spend more time planning where they're going to go on holidays than they do planning for their financial future. If you don't have an investment strategy to keep you focused, how can you hope to get financial independence? It's just too easy to get distracted by all those opportunities that keep cropping up. Unfortunately, many of those supposed opportunities just won't work out as expected. Look how many investors got bought off the plan, got caught out and ended up buying secondary properties that ended up valuing considerably less than what they paid for, or those who chased the next hotspot have been now left with properties that have underperformed. The next lesson I'd like to share with Warren Buffett is his lesson of investing countercyclically. He's a renowned countercyclical investor, advising that we should attempt to be fearful when others are greedy and be greedy when others are fearful. Now, this strategy also works for property investment and has proved the winning formula for a lot of investors. But having said that, I've explained to you in previous podcasts, while timing is important and you don't particularly want to buy right near the peak, I've explained how successful investors seem to make money at all stages of the cycle. I guess you've also noticed that unsuccessful investors seem to lose money in the good times and the bad. So successful investors don't necessarily invest countercyclically. They pay attention to the cycle, but they invest when the time is right because they know they're not buying the market. They're buying individual properties in the market and going to take advantage of them. A great lesson I've learned from Warren Buffett is that sometimes it's best to do nothing. He says the trick is when there's nothing to do, do nothing. Yet I've found many investors get itchy feet and they want to do more. They want to put another deal together, buy another property. There are just some stages of the property cycle, or sometimes it's just in your own investment journey, when it's best to sit back and wait for the right opportunities because, as Warren Buffett also says, wealth is the transfer of money from the impatient to the patient. In the current stage of the property cycle, at the current time when a lot of people are having difficulty getting more finance from the banks, sometimes the right thing is just to do nothing, to hibernate. Rather than trying to buy a cash flow positive property to get you a bit of extra income, that's not going to make a difference. Rather than looking for a cheaper secondary property, a funny way to do things, that's not necessarily going to work. You've got to remember Warren Buffett's first rule, adhere to a proven strategy. And so rather than trying to find another way around it, sometimes the right thing is just to do nothing and wait, because this too shall pass. Now, I love Warren Buffett's other philosophy. He says you should specialise, not diversify. Of course, this goes against conventional wisdom, but Buffett's adopted a focused investment philosophy, investing the bulk of his funds in just a few companies. However, most advisors suggest to diversify. But in my mind, this is really just playing the game of investment not to lose, rather than playing the game to win. Diversifying leads to average results. On the other hand, successful investors, they specialise. They become an expert in one area, in one niche. And that way, by becoming an expert, they can reproduce their results over and over again. Warren Buffett's known as a value investor. He says it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now, that's the same with property, isn't it? You make your money when you buy a property, but not by buying a bargain. You lock in your profit by buying the right property, one that's going to outperform the averages in the long term because of its scarcity and because of the potential to add value. You make your money by buying what I call an investment grade property. And if you're not sure what I mean by that, go back to podcast number 1, where in fact I go through that in detail. So, don't look for a bargain. Remember, the price you pay for a property isn't the same as the value you get. Successful investors know the difference. Another lesson we must learn from Warren Buffett is it's important to invest for the long term. Buffett admits he can't predict the markets. He doesn't know where they're going to go in the short term, and he's quite certain no one else can. So instead, he takes a long-term view of the market, saying, if you won't feel comfortable owning a stock for 10 years, you should own it for 10 minutes. Similarly, those who've created wealth out of property took a long-term view. Now, this doesn't mean buy and forget. As you know, I believe you should regularly review your property portfolio. So my question to you is, when was the last time you checked to make sure you were getting the best rents, or that your mortgage was appropriate for the current times? Maybe it's time to refinance. Maybe you could get a bit out against your extra equity. Maybe you could use it to buy other properties, or maybe you're just going to use it to top up your buffers. And sometimes it's appropriate to consider underselling an underperforming property to enable you to get a better return. Another rule of Warren Buffett was don't invest in anything you don't understand. During the recent boom years, investors' hunger for returns took them to exotic terrains, whether they realised it or not. Promoters were often promising large profits using some opaque schemes. And it happens every cycle. Warren Buffett insists you should never invest in anything you don't understand. He doesn't, I don't, nor should you. The last of Warren Buffett's rules I'd like to discuss today is manage your risks. Many investors don't fully understand the risks associated with property investment, and therefore they don't manage them correctly. One common error, as you've heard me say over and over again, is not having a sufficient financial buffer to see you through the more difficult times. Smart investors have financial buffers in their lines of credit or an offset account or something like that, not only to cover the negative shortfall, but to see them through the downtimes, like we experience every cycle. So what smart investors do is they don't only buy property, they buy themselves time. Another way smart investors minimise their risks is buying the right properties, ones that are going to remain strong and stable, investment grade properties, and then owning them in the right ownership structures that are going to legally allow them to minimise their tax and protect their assets. And a final lesson from the master is that bad times will come and go with surprising frequency. Over your investment life, you're going to have good times, bad times, periods of high interest rates, periods of low interest rates. If you end up focusing on sound financial strategies, if you have a big picture goal, if you have a long-term strategy, you're going to be able to gain financial independence through prudent investing. Some great lessons from Warren Buffett. Have a think about it. What could you do like Warren Buffett to become a successful investor?
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Each week in Michael's Mindset Moment, I share with you some of the tips and secrets of successful people to help you become more successful. The aim is to help change the way you're thinking, to start giving you wealthy and rich habits, which of course I discussed in my book, Rich Habits, Poor Habits, that I've written with Tom Corley. If you haven't got it, you really should get a copy of it. But what the aim is to show you how other people have achieved what you want to achieve, but because you've got to think like them. As I've often said, you can't drive a Lamborghini with the engine of a Hyundai, so we've got to upgrade your wealth operating system. And one of the great ways to do it is learn the habits of people who are already successful. One of the people I like learning from is Warren Buffett, who is a far better investor today than he was 50 years ago, and he attributes that to the fact that he continuously learns. He always learns. And let's go through a couple of his quotes to get some ideas. One of them is the difference between successful people and really successful people is that really successful people say no to almost everything. Now that's interesting, isn't it? They don't keep chasing the next shiny toy. They become an expert at something. For you to become an expert, you've got to do the same thing 100 times rather than 100 things once. Warren Buffett talks about the concept of focusing on one thing and becoming really good at it. Another great quote from Warren Buffett is, what we learn from history is that most people don't learn from history. That's interesting, isn't it? The four most dangerous words a property investor can say is, this time it'll be different. Go back to history, see why cycles occur, see what stops them, see what sort of properties are going to be in strong demand in the future, learn on how demographics has changed, keep learning and learn from history, knowing that it will never be exactly the same, but it's going to be pretty similar. Another great quote from Warren Buffett is, diversification is protection against ignorance. It makes very little sense for those who know what they're doing. I guess this sort of goes hand in hand with the first quote, which basically said that successful people keep doing the same thing over and over again and keep focusing. So diversification leads to mediocrity, leads to averageness. I'd suggest rather than not putting all your eggs in one basket, I'd put them in a sound basket and watch them very, very carefully. The last quote I'd like to share with you today from Warren Buffett is, you only have to do very few things right in your life so long as you don't do too many things wrong. I guess what he's suggesting is that to be successful, you don't have to do so many good or right things. What you've got to do is just get up every time things don't work out. You've got to be strong and persevere and have another go and get up one more time than everybody else. And if you do the right things, success and wealth is going to come to you. I'm going to share more mindset messages in every other weekly podcast, but if you're enjoying this, there's lots more mindset and success blogs at propertyupdate.com.au. If you don't already subscribe, please go there and do so.
If you're enjoying our show, please subscribe on iTunes. You'll find us there as Michael Yardney Podcast, and we'd really appreciate it if you would leave us a review. When you do, we'll read it out on the show. By the way, Michael creates a lot of content he only sends out by email, which you can have with no obligation. So also visit michaelyardneypodcast.com and subscribe to his commentary there.
Thanks for sending in all your questions. There were so many. I think once a month or so I'm going to have to do a whole program on questions and answers, answering some myself and getting some experts as well. Today there's a question from Darren Davies from Seaford, Victoria. Thank you for your question. By the way, if we read out your question online, I'm going to gift you a book, and Darren's going to get his gift in the mail. To answer this week's question, I've got Ken Race, Director of Metropole Wealth Advisory, because it's a tax and structuring related question. Now, Darren asks, what are the benefits and the drawbacks of purchasing an investment property in different structures? For example, in my personal name, in a company, in a trust, in a self-managed super fund. Ken, I bet you that's a common question you get asked when you see clients.
Very common question. And the biggest mistake I see people make is they ask it too late. They sort of come to the office on Monday having signed a contract on the weekend at an auction. So you have to find out the name you're going to put on the contract well before you go and buy. So having put that aside, quite significant differences. I think if you're buying your family home, for the majority of people, it'd be buying their personal name. Not necessarily so for some litigious professions, but in the majority of cases, the family home in a personal name. For an investment, however, you've really got to say, what do you expect out of that property? Is the cash flow positive? Am I using it in business? Am I going to be wanting to live in it in the future? So if we put those issues aside, if you buy in your personal name, you're locked in. That's the person who's going to get all the rent and all the capital gains in the future. So some people who want a bit of flexibility then say, well, I'll buy in a company. The problem with the company is you really have no asset protection because you probably own the shares. But worse still, you will probably pay double the tax compared to having bought it in your personal name because a company doesn't get the 50% general discount.
For capital gains tax you're talking about there.
Yeah, the capital gains tax, 50% discount. And that's why a lot of people move to a trust. And again, whether you're a wages person or whether you're in business will determine what type of trust. And a lot of our clients are using now their self-managed super fund to buy property because they like the idea of leverage. They like the idea of using their super guarantee in a more effective way. So a self-managed super fund is just another form of trust that has some tax benefits later on. You can buy that property, you can fund it with debt in super, you can do your cosmetic renovations. So the beauty of the self-managed super fund is when you're in retirement, at least you pay zero tax on the rental that you get or the capital gains if you ever sell the property. So that's probably the long and the short of it.
Having said that, of course, superannuation funds are not suitable for everybody. So I think we've got to put the disclaimer that even though Ken is an accountant and wears a financial planner hat, this isn't specific advice, of course, Darren, and you've got to seek specific advice because while there are some real advantages, and I know a lot of our clients do own properties in the self-managed super fund, and I know I do, Darren, it doesn't suit everybody, and there are certain restrictions, like you can't refinance under current legislation that property. So it is in many ways set and forget. So you've got to get specific advice on that. So, Ken, there's lots of different sorts of trusts. How do I decide which one?
Look, I think your first question is, where's your primary source of income? If it's wages, you're probably restricted to a certain type of trust, and that will give you, if you like, the tax deduction against your wages if it's negatively geared. So the Metropole Wealth Advisory Trust that our lawyers put together, that's called a property trust. If you're in business and your source of income comes from a trust where you're collecting your business profits in a trust, then we would put it in a discretionary trust of some sort. And we find the best one is our family security trust. Because one of the things we've noticed is a lot of people are buying assets to pass on to the next generation, to safeguard them within the family. And the majority of trusts that you buy have two significant problems. The first is they stop after 80 years, which means someone in your family will be paying the tax and the stamp duty potentially on that property in 80 years' time. Yes, you might be dead, but why pass on assets that are going to have such a big tax? The other one is to try and maintain those assets in the family group. So the trusts that we use have got a family lineage clause in it, which protects the capital to the lineal descendants of the original people. So not all trusts are the same. Once you decide the broad category,
I guess what you're saying is that some trusts maintain a bloodline of sorts so that it only goes to your kids and your future generations and grandchildren, and it stops what you'd today be calling outlaws, which in the old days were in-laws when things have split up. So in your trust, what you're suggesting is there are certain clauses that keep it close to the family.
Correct. It follows the lineal descendants, so the family tree, so to speak.
Good. One more trust, Ken. Some people talk about a testamentary trust. Give us a little bit of information about that.
Yeah, that's a quite specific and unusual trust for the majority of people. The word testamentary comes, from my last will and testament. So it's a trust that is set up only after your death, but you have to make provision for that to be set up as part of your will.
And it's got huge benefits, hasn't it? And there's no stamp duty or capital gains tax when you pass your assets on at death to it. But the people who own your assets, your descendants, are going to have much, much better benefits and being able to distribute it better to children and grandchildren than a normal family trust can.
Much, much better, because a normal trust or direct, if it ends up having funds going to minor children, the tax rate is 60% and on a sliding scale down to 45%. So there are ways to reduce that significantly if you use a properly worded testamentary trust. It also helps in case of family breakdowns. It also gives much better asset protection. So 3 great benefits that are not very well known by the majority of people, including, unfortunately, a lot of lawyers.
So, Darren Davies, thank you so much for your question. And if you've got a question for any of the experts for the Michael Yardney podcast, just leave your question at the comment section of the webpage. Go there if you're listening on iTunes to michaelyardneypodcast.com. And if we read out your question, we're going to give you a gift as a way of saying thank you. Thank you very much, Ken, for answering Darren's question. I think it's actually probably brought up more questions than it has answered because it's such a broad topic. So, Darren, please get specific advice for your circumstances. Thanks once again, Ken.
Thank you, Michael.
Well, thanks for spending the last 20 minutes with me. I hope you learned something from Warren Buffett, not only from his investment strategies, but you got some ideas from his quotes. And it was great hearing Ken Race's answers to that very common question about how to best structure your investments. I look forward to spending 20 minutes again with you next week when we'll give you some new ideas about money, success, and property investment.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success, and money in around 20 minutes.